All right. Cool.
Oh, nice.
Oh shit!
And then
Hey,
I could probably send out like a link, like a Google Drive link or something like that, and then y'all can always access it whenever needed. Whenever.
Okay.
I've never done this actual portion, but I think when I hit stop, it's just gonna give me a file, and then I just fucking drop it somewhere for you guys.
Cool.
nice. So I'm gonna need you guys. I'm gonna need to sign disclaimers. Like, you guys are officially on the casting couch.
Yeah.
Don't be laughing, Lee. You don't know what that is. All right. So the reason this next week is very important is that the last week that we experienced in the market was very all up, and what we consider that is called a bear trap. It could potentially be a bear trap, a bull trap, as you were, a bull trap. What that means is that, as we talked about before, bull means you believe the market's going to keep going up, and bear means you believe the market's going to be going down. So a bull trap is when a bull is like, hey, I got to buy because this is my last time to buy at this price. So you end up getting trapped. So what I'm going to draw for you right now is not an exact S&P 500, but just freaking a fake zigzag. I'm going to try to get it. All right, so this is where like the low was, and little by little we've been going back up. Can y'all see that?
Yeah.
Yeah.
All right, so little by little we've been going up, and so what the bull trap does is it assumes that you're not gonna hit this anymore. Like you're not gonna go back down to this level. So what does that tell you? It gives you the false impression that you have to buy at this point because you're never going to be able to buy at that point again. Does that make sense?
Yep.
Hey, Larry, can you mute your loud ass kid?
Yeah, my bad.
All right. Let me get it. So there's technical analysis that like experts do, and they don't focus on ups and downs. They focus on trend. So in a long-term view of the S&P 500, this is what it's done. We'll say that was 2008. In 2012, it dipped a little bit, but not that far down. And then in 2018, it dipped a lot. So what experts do is they start and they form something, excuse this line, it's supposed to be a straight line. What they do is they form something called trend lines. So they put one at the bottom, which is called the downtrend. And they put one at the bottom, which is called the uptrend. So it's not just one or two, all right? These lines are called as, the bottom one is always called support, and the top one is always called resistance, all right? So this is the macro version, like the very exterior. You just look at the top and the bottom of it. However, in between, when you take a closer look and you're looking more at a daily chart, you could look at hourly charts. They go more in depth and they have like price targets. So this line right here, down here would be the months, so or the years, however long you're looking at it. That's what would be down here in the chart, and over here would be prices. So how much the S&P 500 is at this point, how much it is at this point, how much it is at this point. All right. So again, this is not exact S&P 500 chart, but this is just to give you an example. So again, this is called support and this is called resistance. All right. All right. Now, why are they called support and resistance? Support is what makes it, it gives it like that floor feeling where you like analysis, and it happens to happen a lot. So that's where like the analysts, they look at it and they're like, all right, if it hits this, once it hits these support levels and it goes through them, it usually drops a lot. Like it doesn't, but then when you see it stop and go back up, you know, all right, now we're going back on an uptrend. All right. So the same thing with the resistance at the top. They call it resistance because the stocks always go up slower than they go down. So the support, again, is like the basketball dropping, bouncing, and going back up. That's what the support line does. And the resistance is just a line up top that once it crosses that threshold, you know, okay, I'm in a safer spot. I'm in a good spot to buy up. So right now in the S&P 500, I'm gonna pull up my phone real quick. But right now in the S&P 500, we're at almost at that resistance level for the next one. Actually, there's a thing in here, right, where you can share your screen.
Yeah.
Oh yeah, I'm gonna do that real quick. I'm gonna share the screen.
Okay.
And I'm just gonna do it on here. Google Chrome.
Oh, so here's a whiteboard.
Oh, gotcha. Google Chrome. Give me a second. Somebody else just joined too, which is good. I'll just give permission. Hey kid, welcome to the chat.
We're all served.
Right.
Hell no. Can y'all see my screen? Do you see my? No. Can they see my screen?
Can you guys see the screen right now?
Yeah, we got it.
All right. So what I'm gonna do now is
Just hit. There you go.
I'm really lucky no weird websites were on.
Hey, don't judge me.
All right.
I like
so
midget porn.
what I'll do right now. So as you go through it, can you guys see the mouse as well?
Yes.
All right. So what you guys see here is, let's see, 1 year. You know what? Since I got Google up. So I like Yahoo Finance a lot because it gives you a lot of tools and stuff that other websites kind of charge you for. So it's loading the interactive chart. All right, so what you could do here is you could change the intervals, you could change the way you look at it. So what we'll do here is we'll click on this and we'll look at candles, all right? So candles, it gives you an interval. So on this specific chart right here, what you're looking at is we'll look at the year to date model, and each candlestick that you see is a day, all right? So let's say this one, for example. So the one that my arrow's on, when you see green, obviously it means that it finished on a higher note. When you see red, it finished on a lower note. Those lines that you see, those thin lines, that shows you how low it actually went that day. Even though it didn't finish at that low, the bottom of that candlestick shows you how low it went or how high it went. These are in the past, but they're smaller because the up and down of it was that much more insignificant. They were really small inclines and declines. All right, so currently where we are right now, we're at 2789 according to this. All right, the next resistance level on the S&P 500 is 2850. All right, so Kid, you kind of missed when we were talking about resistance and we were talking about the support. So resistance is the bottom levels as you go through the chart. Let's max it out. So as you go through here, you'll see that if you drew a straight line from here, I was gonna put my finger like y'all can see it, and up here, there would be times where the S&P 500 drops below that and it goes back up. So when analysts take a deep look into this, they're looking at the analytics of these charts and they go very in depth. They so far where they even go, like they'll click on the 1 day and then they'll look at the hourly chart and they'll start seeing exactly what happened at every friggin' hour, every minute, and it gives them something more to work with when they're looking at the candles. They also have hollow candles. So when you go back, let's say we could go back to the max. Hollow candles just describe the sentiment, whether it was bullish or a bearish sentiment, or when expectations were, it didn't end exactly where people thought it was going to end. So it gives you a deeper view into it. All right. Am I losing anybody so far? I'm trying to I'm trying to build into deeper and more conversations that are more deeper later on. I don't want to throw everything and then you guys are walk out here confused. Right now, what questions do y'all have before I continue?
Sunday fun day.
So what do y'all have? What questions do y'all have? What about you? You got any questions?
Not right now.
All right. So it's important that you guys look at this. All right. But when we talk about indexes, these are just big pictures. All right. Don't let the index fool you on what a particular stock is doing. The reason people bring up indexes and they talk about indexes so much is because it covers the broader market. It talks about what's going on as a whole with people in the market. What is just because Apple's up and Tesla's down, that doesn't mean the whole market is up or down. Does that make sense? Mm-hmm. So in a normal, if there were no coronavirus, before the coronavirus hit, when you would go on to the market, it would be stocks. Some stocks would be up, some stocks would be down. It all depends on what's going on. What happened with coronavirus is the virus hit in January timeframe, and it didn't really affect the market. The market wasn't afraid of it yet because it was just isolated in China, and that was around January 17th, January 21st. All right, so we'll go here. We'll look at the year-to-date chart, and we'll just make it a line to make it easier to look at. So, I'm trying to do this the bottom here. I can't really see the bottom of this because all your ugly faces are all covering the bottom of the screen.
You can get right here. Minimize it.
All right.
Yep, there you go.
Gotcha.
Probably just grab it and move it. Yep.
Oh, all right. Now I don't got to see your faces. Great. All right. So what you guys are looking at right here is the year-to-date chart. All right. So you're looking at all of January. You're looking at all of February and all of March. As you can see, when we got here, this is when the news of the coronavirus started coming out.
Mm-hmm.
You got to January 23rd, and there was a little bit, but not too much. But when it was referred to as a pandemic, it was the 20th or 19th, when the word pandemic came out, that's when the sentiment in the market changed, and when the lockdown started occurring. So then what happened? You got a drop, and it was a huge drop. All right. From the top, it dropped down negative 8.56%. That was the change from the top. It went back up a little bit, and it dropped. So this right here was the first bullish, the bull trap. This is where like you saw it dip, it didn't hit this low. So then automatically it traps you because you think, oh, it didn't retest the low. That's what it's called. When it gets to the lowest point, they call it retesting the low. So at this point, remember, we can't tell the future. So we assume that this is the low point. However, it dropped. And right here, this is where a lot of people got caught. Even Warren Buffett. Warren Buffett bought here. He bought a company called Kroger. He bought a few other companies. And he got caught in the freaking bull trap because look what happened just a few days later. On the 5th, it dropped 6.4%. On the 6th, it dropped 8%. Negative 14.99% on the 9th. Then again, it went up. And then look, that was a huge decline here. It went up again. So now let's go look at this month. All right, so this is the monthly chart. All right, so this is how crazy it's been this month. It's gone, especially like this week right here, because it went the 26th, it went up, went down, went up, went down. This is what is done in the last month. So it covers a little bit of March and it covers what we're at so far in April. So what's been happening right now is that same kind of bullish trap, and this one catches more people because it's as you see the curve right here, it didn't go down, it didn't dip that much. That was this week. Just this week, it was like green and green. Did y'all notice that?
No.
Who's that? Did you guys notice how?
It says it right here. Who's talking?
Oh, as it says your voice.
Yeah, it was Maxwell first.
Maxwell, you said no?
No, I didn't notice that immediately. Obviously, I'm seeing it now.
No, I'm talking about like. So, are you guys looking at these things on a weekly basis or a daily basis to see what the market is doing? If you're not, then you should. What I showed Diego, I'll pull it up on my phone. Let me open this up so I'm. Pull you guys back up just so I can see what I'm showing. So what I showed Diego is this right here. Where's the camera? So this is the Yahoo Finance app. So every day here at the top, starting at like 1 p.m., you can start seeing the futures. So futures, this is just pending orders. So it could be pending orders for buying or pending orders for selling. All right, that's what the futures refer to. So that's what you see at the top. What I've done is I've added the stocks that I either have or that I'm looking at. And what this does is it goes in depth. Like let's say the first one right here is Apple, American Airlines. The next one is Apple. So I'll click on Apple. Once you click on it, you just got to put a star, click on that star, and it'll save it in your watch list. All right. And then the same thing we've been looking at, you'll see it here.
Yeah.
It'll show you like the dates, like the time frame you want to look at. It'll show you the charts. And then it'll show you details on it. So you can see like things like what's the dividend that it pays or, you know, information that matters to you. So another thing you could do is swipe. It's backwards. Hold on. So when you swipe, you see like more in-depth things like this right here shows you what their earnings were for that particular year. And out of those earnings, how much was profit. This is important because you want to know if a company is profitable. All right. So it also has like things, for instance, like analysts, what they think of the company. Do they consider the company like there's 5 levels? Do they consider it all the way from buy to sell? So the number 1 at the top is buy. Then the next one is let me see. This is a strong buy. I don't know if you can see that. Strong buy, hold. When you start underweighting it, and is underperform means that is not going to perform to where you want it to perform. And then 5 is sell. That means get rid of it quick. All right. The reason it's important to look at the history of the stock is because when you look at let's go here. So this right here is Kohl's. The chart's not even available. All right, so a company like Kohl's, right? They have a dividend percentage right now of 16%, which seems really attractive. All right, but they're like fighting for money, so it's really important to know why is the company doing what they're doing? Why is that dividend so high? You can't just get sucked in when you see a really, really high dividend, because a lot of the times there's a reason for that high dividend. And most of the time, if you go back and look at the last 3 years of the earnings and the cash flow of Kohl's, every year it's gone down. So in 2017, they had 3 times more cash on hand than they do right now. So if you start looking at that trend, it'll show you that a company like Kohl's is like suffocating and breathing for air. So what a dumb consumer will do, investor will jump in there and be like, oh shit, Kohl's, I know the name, and they have a 60% dividend. Oh hell yeah, I'm jumping on that. And next thing you know, that price of that stock keeps going down and going down and going down. All right. While we're on the subject of bad stocks, currently right now, man, I would stay away from all Chinese stocks. They look very attractive because they dropped a lot because, the epicenter was there at one point. However, they have like 3 companies right now that are under investigation for lying about their numbers, about the way they reported their numbers. The first one I showed you guys on the group chat was Luckin Coffee. Mm-hmm. Did y'all see that?
Mm-hmm.
So yeah, man, they were at $54. They were like almost on par with Starbucks price-wise. And Luckin Coffee was at $54, and then little by little that shit dropped all the way to like $4 per share. And currently right now it's blocked on the exchange. Like since it's under investigation, it's blocked on the exchange, so you can't buy or sell it right now. So if you had it, you would be screwed because you can't sell it.
Mm.
So a lot of these other companies, it looks like they have great figures, but a lot of them are like fudging their numbers to try to get us to be like, oh shit, that's a profitable business. Let me jump on there. So if you have any Chinese companies, I suggest on this week, starting Monday, if we're in the green and you can sell anything, I would sell all those even if you just get your money back. Because what could end up happening to you is you're going to end up getting screwed over. Who has Chinese stocks here? Any of you guys? I have 2 of them. I have Alibaba.
I got one.
he's like, and I got one called JD.com. So Alibaba was like the Amazon of China, and JD.com like the Google of China. So I'm still low on little ones, so I might just hold it, but I'm definitely not buying any more. And even though Luckin Coffee is at $4 a share, even if it came back, I still would be very skeptical about jumping on board on it. All right. So the big takeaway here is that I don't want you guys to get caught in that bear trap, the bull trap, because the market looks like it's going up. It's been green. It's been green. It's been green. But historically, 2008, 2012, 2016, what happens in these years is that the lows get retested or surpassed. So what you feel right now is the low, like it can easily go there this week. So 2850 is the number to look at. That's the number to look at next. 2,850. That's your next resistance at the top. If it passes that, that's when you can feel comfortable, letting go of some money and getting back into a little bit of cash. Because again, whatever you sell at that level, once it drops, you'll be able to buy it at a lower price. And if you're using M1 Finance or one of these other stocks, one of these other companies that give fractional shares, then you'll be able to have more shares of the same company because you're buying it you sold it at a higher price and you bought it at a cheaper price. What do y'all got? What questions do y'all have right now?
Ross, I have a question if that's fine with you, sir.
All right, but take the mask off before you look all creepy.
Hi, sir. Well, I'm outside. But the question is, so why is it 258 to gold that we're looking for, sir?
All right,
Why
so
that number specifically?
that's a good question. So let me pull it back up on here. So let's zoom in. Give me a second. Let me minimize this.
Roger, that, sir.
Shut up, Lee.
Aye, sir.
All right, so it's kind of hard to see on here, but as you look through and we're looking at the trend lines, right? As they go through, if you drew a line from here and you had it going up, going up, going up, going up, it's hard to see on here, but the next logical trend line on here would be that 2850 mark. This is a weekly interval. Bear with me. Sorry, Jonathan. It was. It's hard to gauge on here, but to answer your question, Lee, is when you follow these charts and it goes like you follow these lines. That's why the graph is here. As you follow the line
Yes,
up,
sir.
the next logical resistance level is 2850. After that, the next one after that was 2936. So that's the next resistance level up.
Was that stated somewhere, or did you find that, or did you just do that kind of like on your own?
Yeah, when I was going through on my own and I found the like following the charts.
We're below that resistance line as of Friday or Thursday. They didn't open Friday, right?
No, they weren't open. They didn't open on Friday.
Yeah.
But yeah, man, as you follow this trend line all the way up, and remember, it's not a line that just hits the bottom of these. That line sometimes goes through these bottoms because sometimes the points here, sometimes they drop below the trend line. So obviously, right here, if you were looking, right here would have dropped below the trend line. Right here would have dropped below the trend line. So as it keeps going up, we're way below the trend line right now. The resistance line. Yeah, those are the key numbers that you want to look at right now, and we're pretty close to the 2850 number. Well, once we get there, if we pass it, the next resistance, the next resistance level after that is 2936. So those are some key numbers to look at. Oh, I only see one of you on here. Oh, there you go. All right. What other questions y'all got? All right. Any comments at all?
I do have another question, sir, if that's fine.
Stop being selfish.
Aye, sir.
What's up, man?
So I was wondering on the graphic chart that you're showing us, what is the difference between the green and the orange?
So again, those green and they're red, but colorblind as mother. They're green and
Aye,
red.
sir.
So the red ones are just, it just lets you know that they finished, they decreased from the previous day or increased from the previous day. So green means increase and red means decrease. And then remember those little lines, some of them have a line up top and some of them have like a thin line at the bottom of them. Those lines just signify how high it got that day or how low it got that day, even though it didn't finish there. Does that make
Mm.
sense?
Kind of so. So I have another question to that one. So you mentioned about when it comes to the green, that's like the time to sell, even though there's like an increase in the stock market. So why would we want to like sell stuff when they're on an increase, sir?
So this is just taking money off the table, and I'm not telling you you have to. I was just talking about the Chinese stocks. Like if this would be a point to kind of get out of them because if there's 3 companies already in China that are under investigation for lying about their numbers, and if it's 3 separate companies in 3 different types of markets, then like there's kind of a trend there. Does that make sense?
Yeah.
So
Mm.
Alibaba could be doing the same thing. JD could be doing the same thing. So even though they're big companies, it seems like a lot of them are under pressure to lie about their numbers. That's the consensus on it. But again, let's get the Chinese stocks off the table. If we're just talking about the regular American stocks, if they got green, a big reason to sell them would be if you feel like the market's going to drop again and you could get those same exact stocks at a cheaper price. Because then you'd be able to get more of them because now you have more money on hand. And then if you wait and wait and wait and it drops and drops and drops like it did before, then you could take whatever you earned and then reinvest that at a lower price. That makes sense, Lee?
Yes, sir. So generally speaking, it's better to like buy more stocks when it's green and sell stock when it's in, or it's just.
That's the opposite. You want
Or
to
is that, sir?
you want to sell high and you want to buy low.
Or is that, sir?
But the only problem is, and the reason I'm going through these charts is that you never know when the high is or when the low is. So how good can you see my screen? Can y'all see it like clearly?
Yeah.
All right. So
Yes, sir.
I'll just do this right here. If y'all want to look more into it, it's called the candlestick chart. So you just click on here and it'll show you, it'll just answer your questions, Lee. You could go on here and it'll tell you exactly what they are. They have different, each of them has like a different name, or like they all have different, even the patterns. They have patterns called the V shape, the U shape. They have, this is not clear, but they have patterns that people who analyze these charts, it's easy for them to refer to them at, like they have names for like little movements in the patterns. They'll have like names for things that get built. They have something called the head and shoulders pattern where it just builds like a shape of a guy. Like it goes up, and then it goes down and keeps going straight. So it's important to start, if you really want to take this serious and you really want to make as much money as you can out of this, it's very important that you guys start like understanding these and learning how to read charts, because everybody can make some money, but the goal between us is to try to make as much money, because we're not millionaires. Nobody in this chat is a millionaire. So like each one of our dollars matter. And even millionaires, man, even the billionaires, like they're like, when shit was going down, they're not fucking in a rush to buy, you know, they want to get the low price just like we want to get the low price. All right.
Get the most of it.
Yeah. So let me go back and we'll go back. One more thing I wanted to cover, just to explain some stuff, because 2 weeks ago, it was just like last week where it was in the green. So when you look here at March 23rd through March 26th, y'all see a big increase right here. All right. So what happened here was it's called rebalancing. So when a stock moves 1 penny up or 1 penny down, it's not like fucking Corporal Lee over here making a purchase. Like to make that penny go up or make that penny go down, like there's like millions of dollars of purchases on that stock to make it move that much. So when you see it drop 13%, 14%, like that's trillions of dollars that are being taken out of the stock market, are being pulled out. All right. So a lot of these stocks, when they move up or down, is not just normal guys like you and me that are moving it. It's hedge funds or mutual fund managers that they have big clients, they have a lot of clients, and what they end up doing is rebalancing. So when the stock market was here and it dropped all the way down here, they automatically have to rebalance, because the way they manage their hedge funds is they say, I want to have 10% gold, I want to have 50% in stocks, I want to have 40% in this, I want to have 30% in that. And then when they dropped here, that percentage dropped of how much they were in stocks. So at that point, they had to rebalance their portfolios. And that's when you saw this increase here, because that was all hedge funds that were rebalancing their portfolios. Does that make sense? So that's something like, if you don't know things like that, you could get caught in that bull trap that we talked about.
Right.
And this could be it. This could be the same thing right here. Another thing is the ETFs and the robo advisors. Like they have the same exact thing. They automatically rebalance. So when they automatically rebalance, they start buying. This is just computer generated purchasing that could be occurring here. It's definitely occurring here, but over here it's possible that it's still like just a second wave of it. So yeah, so when you saw this big increase right there, that was just hedge funds buying. Again, it's not just guys like freaking Lee with his mask on making a purchase of JD.com. It's like,
Aye, sir.
is like days like this, it's us. Like when it moves little by this, it's like, this is when we're the ones participating in it. When you have the billionaires and the millionaires participating in stuff, that's when the shit drops a lot. Like this. Does that make sense?
Mm-hmm.
All right. So again, this is where we were before it dropped. The high was 386, I believe.
Right.
And so we're still far from that. So I'm sure some of you, if you bought here or bought here or bought here, you're still low on some of your stuff. So like you're at this point where like you don't have to time the market at all, because no matter where you buy, you're reducing the quantity of your average share price. Lee, have you been buying stuff, or you're just in here? Lee, can you hear me, Lee?
I can hear, sir. My phone was off. So I haven't bought any stocks yet, sir. I've been just like watching the charts flow by.
What are you waiting for? Christmas?
No, sir. I was just hoping that it would just go a lot lower, but it just keep going higher. So I was just like watching the moment, sir.
Yeah, man, but you can't let all this time pass you by, man. Because even if you would have bought here or bought here or bought here, like what you're trying to do right now is referred to as timing the market. And you never want to do that, man. Because what if it doesn't go this low ever again? You know what I mean? You're never going to get it here. We're never going to get here. So there's no point of trying. Like this is 2010. You're never going to get down here. This is after the .com bubble crash. You're never going to get here. Does that make sense? But
yes, sir.
But even if let's say you bought here, or you bought here, or let's say you bought here, or bought here, look where it eventually ended up. So as a long-term investor, you're just looking at the micro, you're trying to look at the macro when you should be just looking at the micro right now and just analyzing if you should buy it or not buy it, that one stock. But the question is not should I buy? You should be buying. You just have to look at quality. You need to be purchasing quality stocks right now.
Mm-hmm. Roger that, sir.
Again, I said it in one of my videos, and it was my brother loved the line. It's not about timing the market; it's about time in the market. Bars.
Say that again, sir.
It's not about timing the market; it's about time in the market.
Roger that, sir.
It's about how long you're in there.
Yeah, it's a copywritten statement. Don't be using it anywhere.
Yeah, bars.
Hey, I do have a question. And like he said, so the other day I came over here because I only got about $500 going into M1 right now, right? And it's more due to lack of knowledge, obviously some fear, you know what I mean? And I mean, it's just basic stuff, but I wanted to get a better understanding, and I guess that's what Lee was trying to allude to. He broke down certain things to me this week. Probably like last Monday that I came by, and it was just like he said with the Yahoo Finance app, right? Every night before, like he said, so we're out here in Okinawa, so every night at around, what is it
For us,
Yeah.
23rd, at the market.
Yeah.
Market.
Yeah. Market open.
It's 22:30.
So 22:30, the market opens. However, throughout the day, you can start getting on the little Yahoo app, and I like it because you can add your individual stocks to your like list, right? So whenever you log into it, I only have like seven different stocks, right? It's about to be 6. So I might get rid of that Alibaba. But I'm able to see, and when I click on the individual stock, it tells me where it closed at the night before, and if the market is not open, what the future is looking like. So I can kind of gauge it off of that and be like, okay, so it closed at this price, but now it's at a lower price or it's at a higher price. You know what I mean? Like you said, you want to buy low, sell high. So you can kind of see and gauge, and that kind of gave me, I'm a visual kind of guy, you know, typical Marine, right? I like, not really, I need to see what's going on in order for me to be able to make a decision, I guess. So that helped me out a lot. Now, that was just my comment. My question was to George. This week, he mentioned in the chat that he has about $12,000 going into like his pies, right? But then he just started his IRA. So my question to you was, you made a statement and said, had I thought about it earlier, I would have did it in reverse. So my question is why?
All right, so his question is why I would have done it backwards. And right now, my purpose of that is that IRA is like a gift from, like, you know, I'm not a religious person, but it's like a gift from God. It's a gift from the government. It's them saying you can do this all tax free. So the reason I would start with that is because whatever happens on there, I'm never going to be taxed on it because you're doing it. And we're talking about a Roth IRA specifically, Roth IRA, not traditional. We're talking about the Roth. With the Roth, the government already taxed you when you got your paycheck. So when you get that money back and you take that money and you've invested in the IRA, you're not going to get taxed. So I could sell, I could bring all my money out, and taxes is the big reason for it. Because again, if I start selling, if I sell something for profit in my regular account, it's not going to be a full gain because at the end of the year, some of that's going to come out in taxes. Does that make sense?
Yeah.
Not only that, there's maximum limits on the IRA, which is $6,000 per year. So the $12,000 that I had in my regular account, I would have maxed out 2019, which you have until June 15th to contribute to 2019.
Up to 6,000, you said?
Up to $6,000 for the Roth IRA. So you can contribute 6,000, and then you have until April of 2021 to contribute for 2020 your 6,000 for 2020.
Gotcha.
So I would have been maxed out already on both of those. So now, all this extra money would have been going to my regular account. The Roth IRA is like the way it works. Whatever you put into it, any money that you contribute, you can pull it out at any time at no fee, no penalty, nothing like that.
So
However,
it's not going to get taxed if you pull it out or anything?
no, you'll never get taxed on it. Again, Roth IRA, you'll never be taxed, no matter.
Because you only got taxed when you got your paycheck.
Yeah. So the difference is with traditional IRA, if you set it up with M1 Finance with the traditional, you would have to give them your MyPay or whatever your payment, your fucking. They take the money before you get taxed, so they pull it out. It's like an allotment. So they pull it out. So they take your pre-tax money and they put it in. The reason some people prefer that one is because they feel they're making money off of like they haven't been taxed on it, and they think $1 today is worth more than $1 tomorrow, and I'm probably going to finish in a tax bracket that's about the same. So I rather use this money now and multiply it than wait till later on. So if you feel you're going to end up in a higher tax bracket, then why would you want to be taxed later when you could get taxed in your paycheck now like usual?
You'd rather get taxed in PFC pay than freaking
Yeah.
general pay.
You'd rather get taxed as a PFC than as a sergeant major. Does that make sense?
Okay.
Because the tax a sergeant major pays is more than a tax that fucking Lee with his mask on gets taxed.
Gotcha.
So yeah, man, it's free. The Roth IRA is free. You don't have to pay anything for it. The minimum is $500. That's your minimum contribution, but you don't have to use that right away. The minimum is just to start the account and fund it. But yeah, I started Jennifer's. I bought a few stuff for her. She started with the 500, and so I bought it wasn't much to work with, but I bought a few full stocks for her.
You said the minimum. You said the minimum to pay into to start off with the Roth IRA is $500.
Yeah, and M1 Finance, that's the minimum.
It's an M1. Okay.
Do you contribute as needed, or is it like a set amount, or can you do either or?
You can contribute whatever you want after that.
Okay.
So you can deposit whenever, wherever, how often you like. It is not
$500 starter fee, and then just whatever you want to put in after that, up to $6,000 a year.
Yes, and then remember, you have until June 15th to contribute for this year. It was April 15th, but because of the coronavirus, the government extended when you can. It goes with filing your taxes. So the government extended the filing taxes to June 15th.
Right. Okay.
So next year, your deadline again will be April 15th, and the minimum contribution could go up in the future. It went up a few years ago from 5,000 to 6,000.
Okay. Now, where are you getting this? I guess where are you referencing as far as for that information? Like how you just said right there, it used to be 5, but now it's 6. Like where are you getting that information from?
Just research. The most obvious place is the IRS.gov. This is
okay.
It's coming from the horse's mouth.
Right. Okay.
Also, it's I just looked. The tax deadline is July 15th, not
July.
not June 15th. So
July 15th.
Yeah, they extended it 90 days by 60 days. So I just checked right here, July 15th of 2020. So you got 90 days essentially.
Yeah. So and the great thing about that is that you can contribute to last year. So it's like you didn't miss 2019.
Yeah.
Throw that stimulus check in there.
Yeah. Did you guys get your stimulus check?
No, I haven't gotten mine yet. I think it's scheduled to hit on the I think the 15th.
But you received it? Like, do you see it pending?
No, I haven't seen anything pending yet. I'm talking. Some of my guys have gotten emails saying that it's going to hit on the 15th. I personally haven't checked my account yet, but I will.
Yeah, his is on he got 3,900 over here.
Yeah, it's due to hit on the 15th, but yeah, I did get the pending transactions in my bank account, as well as I did get an email yesterday saying that.
Okay, cool.
Yeah, man. Be on the lookout for that.
I'll have to double tap that. Yeah, I'll have to look out for that.
Larry's stimulus check, by the sound of the amount of kids in the background is about to be like 70 G's.
I only got two. They're just loud as shit.
35, yeah.
Hey, don't feel bad, Lee, because you know you hit that 3,900, but you got that 1,200, and that's all to yourself.
Roger, sir.
You know what
If
I'm
I may ask, what is this stimulus check, if I may ask?
So it's the government. They're just trying to help people get through the end of this coronavirus, because a lot of people have been furloughed and a lot of people have been let go, and they're not working right now currently. We just get the benefit that we're in a tax bracket that qualifies for this. So if you make over 90,000 a year, the minimum starts going down. So the 1,200 becomes 1,100, 1,000, 900, 800,
Right.
all the way to 100,000. Once you make 100,000 or more a year, you don't get any money at all.
talking about the proposed stipulations or like what?
Yeah. So the only thing as of right now, the way it's written is that next year you'll be taxed on that money that you receive from the government.
Okay, I was gonna ask that because I've heard both ways. I've heard that you are gonna be taxed, and then I've heard that you're not going to be taxed.
So right now, as of the way it's written right now, you are. However,
Okay.
there's obviously a lot of people that are fighting to, be like, what the hell's the point of this if I'm gonna get screwed in the future,
Yeah, yeah.
So right now it's going to Congress this week. They're going to talk about phase 4, the stimulus for phase 4, and then they're also going to talk about whether we should have to pay this back or not pay this back. The reason the government is saying pay back right now is because of how much debt as America we're putting ourselves in to get us out of the coronavirus. So just since in this year we jumped from like $2 trillion in debt to like almost $7 trillion in debt now, because of the stimulus that the government has done. They've done packages for the big people, and then they've done packages for the small people. So,
Because wasn't that a part of including like what was it, like the $4 trillion that they had already set aside for like pandemics or whatever, and then they had to increase it or some shit?
there was no amount set aside, man. Like we were not prepared for this at all as a government. So
Yeah.
that's why there's 2 different phases of financial system in our economy, and one phase of it is the Federal Reserve, and the other is the Treasury. These are 2 different entities. So the Federal Reserve, they're the ones who they influence things like the price of a loan that you take out, or they influence the amount that your checking account gives you back in your savings account or whatever, your checking account. So these things are all influenced by the Federal Reserve. The treasuries, they're the ones who can do stimulus packages like this where they pay you money back.
Okay.
Hey, I got a question.
What up?
So when they say like the feds cut the rate and stuff, how much does that factor into like the housing market and things like that?
So it does, but it does on a micro level. On the macro level, it's more for the big banks. So banks, the way it works is the banks, they legally have to keep a certain amount of money, which currently is 10%. So they have to keep whatever, let's say, Lee, you put $1,000 in your savings account. The government only has to keep $100 of that $10,000, and that $100 needs to be kept on the overnight market. So the overnight market, the banks, they have to either pay or they get paid to keep it in the overnight market. So that's the macro level. That's the big level. When their fees change, that's how our fees change. When they're paying less, then we pay less. When they have to pay more to keep money in there, then we have to pay more to keep money in there. Does that make sense? So
Yeah.
If it goes to 0%, that's not for us. That's macro. That's what the bank is paying the central bank. The central bank is the one that takes the money from all these banks that is forcing them to keep 10% of that money. So that's the way banks make their money, because Lee puts in $1,000. They keep $100 of that, and they can lend that money to somebody else, and they're gonna make
Gotcha.
money off that $900. So the next person comes, and Maxwell comes and he puts $1,000. They're lending 1,800, and they only have to keep 200 in their bank. So whatever they're paying to keep that 200 in there, or getting paid to keep that 200 in there, that's what affects us on the grand scheme of things.
Okay.
All right. Does that answer your question?
Yep.
What else? What else?
I got something to answer.
Ooh,
Hey, it's like
what's up, Lee?
Kid,
Oh, that was kid, sir.
Show your face, kid. Goddamn.
I can't do that, sir.
butt naked.
You shaved yet?
What do you
Ain't
say?
shaved yet.
What's your question, kid?
So it's just something to add to people that's getting ready to start their Roth IRA. So with my regular portfolio, I have auto invest off. So I would assume it would have kept it off for the Roth IRA, but it didn't. So I just want to throw that out there because it threw my whole 500 into my pot.
Yeah, hey,
How was
kid.
it today?
The same exact thing happened to me, man. I put the 500 in there. I didn't turn off auto invest, and it took my 500, and it bought the very next trading window, and I was like, God damn.
Oh.
Yeah.
Yep.
So it got me.
Oh.
I need to go.
So it took my 500 and put it into. Luckily, I had only 2 stocks in there that I really wanted, so it bought from both of those. But
My 500 just went into Vanguard stock market.
yeah, which is not bad, man, because at least when it goes up, if you wanted to sell it, you could sell it as it goes up. But the only thing is that what I think you missed in the beginning, man, is I was talking about bull traps and how since the market's been going up and going up, people start getting anxious and they start making purchases because they think, oh, the low was the low and it's going to go back to where it was. But we can still retest the lows. Like we can still go back and hit lows again. Did that 500 go into only one stock?
It did, sir.
Yeah. Don't worry, man. I hit it just like you. I got hit just like you got hit. It hasn't been a perfect journey. I've been learning. I've made mistakes.
Yeah.
I've made mistakes, and one stock I bought, it looked really good, and it was I didn't see it was 2 times leveraged. So these are some things you want to stay away from. There's stocks out there that are 2 times leveraged or 3 times leveraged. So this means you could either gain your money at a 3-time variable or 2-time variable, or you can lose your money 2-time variable or 3-time variable. So be careful. I'll sign in right here and show you. It hasn't been perfect. I'll show you the one I'm referring to. I'll show you why to stay away from them. You need a charger? Does this charge work?
It's fine. It was at totally off now. No, I haven't.
Yeah, I see Stanley in the back, Max. Maxwell.
Take a shit.
All right, so
Deal. He just logged in because he wanted to flex.
I'm not. This is not a flex.
Weird flex, but okay.
How do I scroll?
What do you mean?
Because I don't see the arrow. Oh, just 2 fingers.
Wouldn't be human.
Good way to make us feel broke.
you know what I mean?
All right, so this company right here.
The
It wouldn't even show you. So
Hit back.
no, it's here.
Oh.
So that's where I'm at right now on that stock. The value is 0. The 47. That's how much is gone now. That you'll never get back. And the reason why is because, like it says right here, it's 2 times leverage. And I didn't realize that. I didn't even know at the time. I didn't even know what it was. But all it means is on the multiple that it goes. This is the current price of it right now.
24%.
24 cents. And look at the dividend on it. If you put 24 cents right now, you're going to get this much money back. However, M1 Finance, it kicks stocks like these off. Like once they hit a certain threshold, it kicks them off. So this is one that it kicked off. And so yeah, man, stay away from anything that says 2 times leverage or 3 times leverage. This is a mortgage one, but they have some that are like S&P 500 2 times leveraged, or there's one that's like Bull S&P 500 3 times leveraged. And yeah, I would definitely stay away from those. But yeah, in here, you click on this and it'll, where is it at? This is my Roth. You can see my Roth here. And again, my Roth only has 2,000 something in it, which again, that's the reason I would have done it backwards. Well, it's the same one.
Like, was there nobody there?
Yeah, so just the whole purpose of that was not to flex. It was just to show you guys.
it was between going to mine that has nothing or his that's a complete flex. So
Hey, kid. It was this one.
Yes, sir.
This is where my that 500 went.
Ooh. Yeah, mine went to VTI.
Yeah, so, but as you can see, man, like when I first bought this one right here, for example, we'll click on this one. And Lee, this is what I was trying to tell you. When I first purchased this one, it was around 200 and I think $90 something per share. And now, where's it at? The price is 255.
I think your average share.
Yeah. So my average is 252 right now. And that's why you bring it down. That's why as it goes down, you're only buying if you're already in that position. And it's just to bring your average down because you're not losing anything. You're actually gaining because I guess the best way to put it is, if you were willing to pay $100 for that company, why wouldn't you be willing to pay $80 for it or $60 for it? You should be, if you were that encouraged by it, then you should be buying more. Does that make sense? And that's why we buy only in stocks that we believe in and stocks that we understand. And that's what I'm doing now. Obviously, I showed you what happens when you don't do that. What other questions y'all got? This is running a little long here.
I got a question, sir.
What up, Lee?
So, from my understanding with the IRA, is it similar to the TSP, sir, or is it a little bit different?
IRA is different because you get to choose your destiny. With the TSP, you can't go in there and choose individual stocks. With the IRA, you can have full control of your money.
Mm-hmm.
And with the Roth IRA,
Gotcha.
you're never going to pay any money, any taxes or anything like that. With a Roth TSP, you still have to pay fees because you're what it basically is, it's a mutual manager. So you have somebody you have to pay. There's fees and stuff that you don't see that you pay monthly.
Mm.
And with those, you end up paying all of that at the end of your, whenever you pull that money out, you're paying all those fees back, which is pretty, like you weren't expecting to pay all those fees back. Does that make sense?
Yes, sir. In regards to that one, I did a little bit of some of the research, but not in depth. But there's something I found about the IRA certificate. Do you recommend that one, or do you prefer the Roth IRA, sir?
I mean, I'm not saying don't do any of these other things, but I'm saying you should max out your Roth IRA. You should have a Roth. You can have both. But the Roth certificate, the percentage you get back on that is like 2.3% or 2.5%. But when you control your own destiny, you can make back 10% a year. You know, there's years where you're going to make back 20%. There's years where you're going to make back 3%, 2%. There's some people who didn't buy back and they're going to end this year making no gain, you know, depending on how the rest of the year turns out. So with the Roth IRA, you can control your own destiny. The only time you'll pay a fee is if you get like an ETF, because ETF, they come with their own, ETFs have fees they pay is like a fee for managing the account, the same thing. But the only difference with the ETF is that it's electronically controlled. So you're paying the robo-advisor, which is very, very minimal. It's 0.3% for some. So if you're going to choose an ETF, this is why you choose them. All right. This is why you do your research, because you go to SPY, which is a popular one.
No, ma'am. Thank you. I got some water.
So you go to SPY and you see it has a 0.09% fee. So what this means is you're going to pay 9 cents for every $1,000 that you have invested in this stock. All right. But then you go to VU, which is the same exact, it tracks the same exact thing. It's just a different company. And Vanguard, they charge you for the same exact thing, 0.03%. So instead of paying 9 cents for every 1,000, now you're just paying 3 cents for every 1,000. One thing that did change was the dividend yield. So on the other one, it was 2.08, and on this one it's 2.07. But when you decrease that expense ratio, this one is still the cheaper one, and you're paying for the same exact thing. They track the same exact thing. There's other ones that are more expensive, so you got to be careful. They might sound attractive, but you just got to be able to pay. So this one is $4 for every 1,000. I'm sorry, this one's $7.50 for every 1,000.
Like the shows.
That's how much you're paying $7.50 for every $1,000 that you invest in. And when their returns are high, then you know if you're getting 20% back on your money every year, then you're willing to pay that. That's why people are willing to pay that money. There's some that are you have to really pay attention, because there's some out there that have a number on this side of the decimal. So you have some that are like $400 for every $1,000 invested. So, I mean, I would stay away from those. I don't want to lose $400 because they're going to make me back $400. So just be wary of that. What other questions?
Sir?
And that's just for funds. Regular stocks, I say 99% of them don't have any expense ratio at all. But again, you don't know that unless you do your research. What else? While you guys are thinking, I'm a. How do you open this?
The other one. This one. Great one.
How do you like bring the whole app back?
Oh, you gotta stop security.
No. The whiteboard. Remember the whiteboard? I
Yeah.
just want to see what the whiteboard looked like on the. Ah.
If it was a touch screen, it would be a lot better.
Yeah.
Hey, that was cool.
Roger that, sir.
That's a cool thing. All right. What else y'all got, man? Any other questions you guys got? It's not gonna be the last time we do this. I'm gonna start doing this. I'm gonna start doing this at the end of month, probably the last weekend of the month. But I just did it this time because of how important this next week is, and I don't want you guys getting caught in bull traps as you guys are, like, contributing to your portfolio. So we haven't had much red in a while. So if you guys continue to see green, just be patient. Hold on, because it's gonna dip. And what's gonna cause the next round of dips is once earnings season starts this week. Earnings season for this week is gonna be just the banks. So there's like 5 or 6 banks that report their earnings this week. But once earnings season starts, a lot of investor sentiment may change from all this green that you're seeing, because they're going to start seeing that these companies aren't making as much as they thought they were going to make. So there's companies that are going to have great earnings like Walmart and Costco, but then Apple, even before this happened, they already said that they weren't going to meet their earnings for April and March. Disney is kind of up and down because even though they lost money in the parks, they over exceeded what they thought they were going to do with the Disney Plus. They just hit 50 million subscribers. So they might be like right in the middle of where they might just be at baseline. But earnings play, like when the stock market is normal, even though the fundamental of that company didn't change at all, when investors, they see earnings reports and they see, oh, it didn't meet the expectation, they're like, sell. So just because your company doesn't meet the expectation, like it doesn't mean it's the end of the world. You got to sell it right away.
Hey, so I got a question.
What's up?
Just so I'm making sure I'm understanding this right. So what if a stock, let's just say, has a dividend yield of like 48? Is that good or bad?
48 point something?
48.81.
So if it's that high, sometimes like when the company comes out and they don't say we're going to give you this percentage for the next quarter. It comes out quarterly for most companies. They say we're going to give you $2 for every $2 a quarter. So this is one thing I want you to understand. Can I type here?
I don't know. Yeah, there you go.
All right, so shit.
Roger, sir.
All right, so that one you're looking at that says $48. How much is it? Does it show?
$2.52.
$52. So whenever you see that on the individual stock, you have to divide that by 4, because that 252 is going to get split into each quarter. So you have to subtract 252 divided by 4. So that's 63 cents you're gonna make every quarter if you had 1 share. So that's why on a lot of them I'm trying to get to 4 shares. So I just wanted to, before I answer your question, I wanted to make sure that was clear. A lot of people don't realize that, and then they get their first dividend payment, and they're like, "Am I only getting?"
So that would be shit, correct?
Yeah. Why am I only getting 63 cents? All right. So to answer your question, it's hard to answer your question because 48, it sounds bad, but it could just be that company trying to maintain that 252 price while their stock is like plummeting down. Does that make sense?
Yeah.
So their stock dropped a lot, and they have to pay that $2.52 for that quarter.
So like the more you own in that specific stock, like I don't know, 2 years from now, if it skyrockets, you'll make like a lot of money.
It's more longer than that. It depends how much you own of it.
Right.
Like,
Okay.
the one guy I told you guys that he went on Kramer and he said he owns 6,000 shares of AT&T, and that's what he pays every month. That's what he pays his mortgage with. He gets $3,500 something dollars in. Oh no, he had 81,000 shares or something, but he gets $3,500 every quarter. And that's just one of his stocks. You know, he's got other stocks. And this is an old guy that's probably been doing this since he was like Lee's age. You know, so. But yeah, man. Whenever you see on a normal basis, you see a high dividend, is usually like bad news, or it's either that bad news, like stay away from it, or is that company just maintaining that price that they promised they would pay investors, which was $2.52 for the stock that you're talking about.
Right. Okay.
What other questions I got? All right, so just to wrap it up and recap what we went through, be wary of the bull traps, stay away from them.
Just brought it with me.
All right, yeah, man. So when you start seeing this stuff, and it dipped a lot, as it comes back, even though it's doing this, it doesn't mean that it's gonna keep doing this. The next resistance level is 28. That's ugly. It's 28.50. Goddamn.
Oh yeah, it's still halfway.
Hold on.
Hey, Max, I see Stanley in the background.
What do you mean he's standing? Oh, you do see him?
Yeah.
Stupid, man. Like what is
So 28.50 is the next resistance level. And this is what I mean. Like it could hit, and that's what the resistance means. If it hits, then it usually means a sharp decline. And again, in 2001, 2008, 2012, 2018, these lows were retested every single time. So if you're basing it based on history, this will be a good signal of that. Once you hit that 28.50 number, if it starts going down, like I would be patient. I would be patient and hold on, because you may retest these lows, or it may even, surpass them depending on how the earnings reports are. And all depends on investor sentiment. So pay attention to the news, see what's going on in the news, because what is going on in the news, it plays a big part to what's going on. what I need you to think about right now, and this is the last thing I'll leave you guys with, is even though this is a moment where you can't just look at the micro of your company, all right? So don't just look at, let's say, Apple. You can't just look at Apple as the company. That was what you were thinking? Yeah. So don't just look at Apple. I just said it because that's what this computer is. Don't just look at the micro, which is, I'm just going to look at Apple and see what Apple is going on. Should I buy more Apple? Because based off what they're doing. What you need to do is look at every external entity that goes along with Apple. What's going on? Because semiconductors they create the chips that go inside of everything you own. So cell phones, computers, everything you have was manufactured, pieces of it were manufactured by semiconductors. So when you're looking at the macro picture, what are those semiconductors? What's going on with those? The people that were selling Apple these prices, are they going to have to increase their prices? If they have to increase those prices, that means Apple's going to have to increase their prices. And if consumer sentiment is down, that means people aren't going to go and buy a $1,000 cell phone when they're debating if they can pay their rent next month. So that's when you look at it, that's looking at the macro. That's only one example, but every company has that. Every company is not self-sufficient. They have people that they have to pay, or they are paying. When you go into the building of Microsoft, like, they have people that come and clean their offices. You know, if you were investing in that company that was cleaning their offices, do you think they're still going to have work? Is that something that Microsoft's probably going to say, hey, freaking Lee, go clean the porta john? They're probably going to pay their employees to start doing that stuff, because paying a person to come clean is probably an expense they can't afford at this moment. And that's what happened in the recession. A lot of these little jobs, people started doing themselves that they used to just pay other people to do, like gardeners. You know, that's something that you don't need, is something you want. And that's when you got to look at the macro of everything. It's called the macro economy.
Yeah.
That's a new share.
Share.
My face.
Yeah, I think that's top. Or you can just stop share.
I'll stop share. All right, so
Everything.
any other questions? I think we covered a lot. How long was that? That was a little over an hour. 30 minutes? What was it?
Oh, and you always leave us.
Yeah. Is that the real time? 11:09?
Yeah.
Hour and a half.
Oh, shit. Hey, Zoom just gave us this free extra time as a advertisement.
And if I get charged, I'm just charging it to one of George's melting pots.
Yeah, man. Is Claire there?
Yeah, she's on the phone with her mom right now.
I was gonna have her say hi to this one. But all right, thank you very much for joining me, gentlemen. I hope you guys come back next time. If you guys give me some more to work with, then I'll have a better product for you guys next time.
Okay.
This was more off the cuff, but
No,
did you guys
definitely.
learn some stuff?
Absolutely, sir.
Yeah.
All right, good, man. I'm glad it wasn't a waste of time. Larry, your boy never showed up. What's up?
Let me see what Larry looks like.
Oh no, I guess it tapped.
Larry guy.
My wife wants to see what you look like,
That's-
Larry.
So that's what you look like, Larry.
Yeah, I'm in San Fran.
Yeah, I feel like I have a relationship with you just with your name. 'Cause that's what's your background?
You see,
Appreciate it.
see he's in the office. He doesn't watch.
Mhm.
Oh, you don't want to?
Mhm.
All right, man. Thank you so much for your time. Lee, did you get something out of it?
Absolutely, sir.
Kid,
Yes, sir.
did you get something out of it?
Yes.
All right, good, man. I'm glad we'll do this again. I'll give you guys a date. But until next time, Future Focus team.
Man. Later.
Later.
Raw gentlemen.